Welcome to the heart of the City of London on this typical damp October's day. Now, there are plenty of challenges facing investors at the moment, problems in both the Eurozone and the US, both topics which I discussed with Manoj Ladwa, who is the head of markets at TJ Markets, situated just around the corner. So what's the biggest concern for you? Is it the problems in the Eurozone, in particular Spain, or is it the US, the presidential election and the debt cliff over there?
Well, I think it's an amalgamation of a number of factors. We've obviously got the European situation, which hasn't gone away. It's been going on for a number of years now, and it's shifted from Greece, Ireland, etc., to the bigger Eurozone countries such as Spain. Unemployment is extremely high over there. They've got a banking sector, they've got a property sector, much like the UK over here, but under severe pressure. And as long as you've got austerity measures being implemented over there, then growth is firmly on the back burner. So they've got to deal with their debt, they've got to deal with reducing that debt requirement and ultimately getting back to growth. But as long as this situation carries on and the Eurozone carries on pumping more and more money into the situation, it's unlikely it's going to be resolved anytime soon. Now, with regards to America, we've seen the Federal Reserve pumping more and more money into the economy. It's managed to carry on growing it, but unemployment is still a major factor there. The property market hasn't really recovered, and ultimately, if the US does start to slow down, it impacts on the rest of the globe as well. And of course, there's the Far East as well. We've got economic numbers coming out from China indicating that China is slowing down. Only this morning we had manufacturing numbers coming out indicating a contracting manufacturing sector over there, which impacts on us here in the UK and across the globe as well.
So bearing in mind all you said, doesn't it make the euro dollar a particularly tough pair to pick at the moment?
Well, the euro dollar has priced in a lot of the downside over the last couple of years or so. So we've seen a shift down from around about 150 versus the greenback down to the early 120s. From there it bounced, and this happened in the last couple of weeks or so, and we've seen a move up to around about the 130 level. So it has factored in a lot of that negativity. What we could find is if the problems within the Eurozone worsen, and if country as big as Spain or even Italy was to go become under more pressure, so to speak, then we could find that the euro dollar does sell off beneath that 120 level. The level technical analysts are looking at is around about 115. I think it'll be hard push to get down there, but anything can happen in this current environment.
But if we say that the Eurozone crisis does get a respite, that Spain does seek the bailout and attention does turn to the US, what sort of range are you looking at there? Do you think will remain above 125?
I think the euro dollar will remain above 125 for the near term. Certainly if the situation within the Eurozone lessens or doesn't get any worse, and then we could start to see a push back above that 130 level as demand for the euro comes back. And certainly if we start to see more and more stimulus action from the Federal Reserve, then it further weakens the dollar and demand for the euro naturally increases.
Gold has caught the eye of investors recently. Do you see much more upside there?
Demand for gold is fairly unique at the moment, in that where we've got inflation across global economies due to stimulus measures carried out by central banks, and therefore gold is a natural hedge against inflation. And then also, if there's uncertainty with regards to the economic environment, gold is a natural safe haven asset. So it's up from low levels of around about $1,500-$1,600 up to close to $1,800 at the moment. It's nudging up against resistance, and up here, if you're looking at it purely from a technical point of view, it does look relatively overbought, but I think the fundamental demand for gold is still relatively robust, and we could see it back up to previous highs around about $1,900 an ounce and maybe slightly beyond.
Given your experience, even moving away from currencies and gold, what other asset classes are you looking at as a safe bet at the moment?
Well, certainly equities, because equities in a negative real interest rate environment, demand for equities is relatively robust, and you're seeing demand for high yielding equities at the moment, stocks that are paying out a decent amount of dividend, that is attracting investor interest, that have relatively large amounts of cash on the balance sheet, and they don't know, the companies don't know what else to do with that money other than pay out increased dividends. So equities is certainly a hot area, although I'd be wary about where to park money. Utility stocks, defensive stocks seem to be attracting all the funds at the moment. The more cyclical sectors, such as commodity-related stocks and mining stocks and the banking sector, they move to the upside, and then you start to see a wave of selling coming through as well. So I'm shying away from those sectors and moving more towards defensives.
Just to finish off, we've got major central bank meetings this week, Bank of England, ECB and also the BOJ. Are you expecting any particular action there?
Not this week, although I think in the fairly near future we could start to see the Bank of England increase its asset purchase programme. There's not much room to manoeuvre on interest rates, but after the Federal Reserve has announced QE3, we could see other banks follow suit as well. I think ultimately the ECB needs to move, and if it doesn't make a decision by December this year, then we could find that they reduce interest rates or start to stimulate European economies early next year, but possibly February, March time.
Well, that's all for the moment. I'll keep the interviews coming thick and fast from London for Dukascopy TV, but for now, goodbye.